Okay, one way to solve the big debt ceiling problem, get rid of it altogether. Well, that's what credit rating agency Moody's suggests. Let's see what my next two guests think. Dan Mitchell, senior fellow at the Cato Institute, and John Hilsenrath from the Wall Street Journal. Welcome to you both. Great to have you here. John, I'm going to start with you. I want to read you exactly what Moody's said. You know, it's being interpreted as get rid of the debt ceiling. Here's what they said. The current wide divisions between the House of Representatives and the Obama administration over the debt limit creates a high level of uncertainty and causes us to raise our assessment of event risk. We would reduce our assessment of event risk if the government changed its framework for managing government debt to lessen or eliminate that uncertainty. Is that a smart move? Would that work, John?
Well, you know, what they're saying is that the government should have some other kind of framework, like Chile, requiring that the government have only a certain percentage of debt, as a certain amount of debt as a percentage of overall GDP. You know, frankly, I think the debt limit is doing exactly right now what it was set out to do, which is forcing Congress and the White House and Washington to have a real serious debate about the nation's fiscal priorities. And that's exactly what has to happen right now. So you could argue that the debt limit is working.
Well, Dan, I don't know about Chile as an example for us to follow, but what if there was no debt ceiling? What would happen?
If we had no debt ceiling, they would just continue to tax and spend and borrow and spend without any constraint whatsoever. This debate we're having exists, as was just mentioned by the other guests, exists only because we do have a debt ceiling. Now, whether or not we wind up kicking the can down the road, at least for a little while, we're focusing attention on the fact that we are on a path to become Greece. We don't know whether it's going to be 2 years from now, 5 years from now, 20 years from now, but the combination of entitlement programs and demographics have us heading off a cliff. And if we didn't have the debt limit, we wouldn't even be paying attention to it.
So,
you know,
John,
it's ironic because Greece had its own form of a debt limit. The European Union is part of membership. The rules of membership, countries were supposed to keep their debt to 60% of GDP. Everybody violated that rule. It's really about political will, and that's what this debt limit is creating. It's forcing politicians to come up with longer-term solutions to the problem.
Well, John, you know, everybody's really mad at Moody's right now about even bringing up a downgrade idea here. Are we shooting the messenger?
It's kind of ironic, right? Because Moody's and S&P messed up so badly with rating our mortgage securities, and now they're coming and telling us that they might downgrade the federal debt. It is kind of shooting the messenger. You know, I find it interesting. We kind of have what I would call the bond rating vigilantes. The bond market back in the early 90s forced Washington to address the deficits by pushing up long-term interest rates. Long-term interest rates right now are very low. So there's a question of who's going to create discipline. Ironically, it's the rating agencies that did such a bad job a few years ago rating mortgage debt.
All right, Dan, I want you to, I don't know if you have return, if you can see this full screen we're going to put up, but it's about Democrats being on a spending spree. And if you look at it, what you see is even though the recession ended way back in June 2009, spending in 2010 stayed at 24% of GDP. This year, it's headed to 25% of GDP. Look, I mean, isn't the problem simple? Don't we have a spending problem?
I definitely think the problem is spending, but it didn't just begin with Obama. Let's not forget that when Bill Clinton left office, federal government spending consumed only 18.2% of GDP. So Bush took us on a spending binge. Obama promised hope and change, but he just picked up the baton and continued racing in the same direction. But you're exactly right. Spending is the problem. And so when the president says he wants a balanced approach, that's, of course, Washington code words for I want the other side to raise taxes so I can spend more. We got in this problem because government spending's been out of control, and the only solution is to try to restrain spending because we've seen in all these European countries, they raise taxes, but it's like a dog chasing its tail because the higher taxes simply cause even more spending, not to mention the fact that it tends to depress the economy a little bit.
Well, that's my next question, John, for you quickly. Goldman Sachs on Friday is saying, hey, growth isn't going to be what we thought it was going to be. It'll be well below 2%. Are we going to go into another recession here? What's your estimation?
We're vulnerable. We're certainly vulnerable. We will have had basically the first half of 2011, which a lot of people were predicting was going to be pretty strong, is going to come in at growth of less than 2%. growth like that very often precedes an absolute downturn. You know, I think we have an economy that is extremely vulnerable to shocks right now. When you're only growing 2% a year, it doesn't take a lot to put you into the negative, as you would say. So, you know, what would that shock be? The scary thing is there are a lot of potential shocks out there right now. If Congress and the White House don't come up with some kind of agreement that allows them to rein in debt, to forestall a downgrade, and to raise the debt ceiling, we could be staring at that shock in just a couple weeks' time. Europe is a potential shock. China is a potential shock. There are a lot of landmines out there, and we have a lot really hanging on the line right now of a bunch of politicians in Washington. I hope they get the seriousness of the situation they're in.
Well, I think there are a lot of potential shocks out there. Yes, Dan.
Keep in mind that if we have European-style fiscal policy, which of course is where we're heading, it should be no surprise that we're having European-type stagnation.
Well, hopefully you guys will have better news next time you come on the show. Dan and John, thanks for the help today. We really appreciate it.